Silver markets have experienced sharp volatility following a rapid price decline that unfolded in less than 48 hours. During that period, silver moved from $96.40 down to $78.60, marking a 19% drawdown. In the same session, the Dow fell, the US dollar climbed to a 6-week high, and the ISM Prices Paid Index registered 70.5, its highest reading since June 2022. Rising inflation concerns reduced expectations for interest rate cuts, and margin calls triggered widespread liquidation of leveraged silver positions, pushing prices down through key technical levels, including the 200-period moving average at $87.69. By Wednesday, March 4th, silver had recovered to $85.64, while JM Bullion's ask price stood at $86.77. Despite the rebound, several underlying market indicators remain under close watch. Registered COMEX silver inventory has declined significantly. On February 9th, registered silver stood at 102,256,630 ounces. By March 3rd, that figure had fallen to 87,985,490 ounces, a reduction of 14,271,000 ounces over 22 trading days. Combined registered and eligible COMEX vault holdings totaled 355,173,810 ounces on March 3rd, compared with 532 million ounces in October 2025, representing a 33% decline over 5 months. March has also seen elevated delivery activity. More than 52 million ounces have been delivered, representing 10,526 contracts standing for delivery on first notice day, February 27th. By March 3rd, 5,694 of those contracts had been delivered, including 607 contracts on March 3rd alone. As attention turns to the May contract, the scale of open interest relative to available registered silver has become a central focus. As of March 3rd, May open interest stood at 80,274 contracts, representing 401,400,000 ounces. This compares with 87,985,490 ounces of registered silver available for delivery on COMEX. The gap between open interest and registered inventory forms the basis for several delivery scenarios ahead of first notice day on April 30th, 2026. If 10% of May contracts stand for delivery, that would equal 8,027 contracts, or 40,100,000 ounces, representing 46% of registered inventory. At 15%, the total would rise to 12,041 contracts, or 60,200,000 ounces, accounting for 68% of registered supply. A 20% delivery rate would equal 16,055 contracts, or 80,275,000 ounces, representing 91% of registered inventory. At 25%, registered inventory would be fully claimed, with contracts remaining outstanding. In January 2026, approximately 62% of contracts entering the delivery window ultimately demanded physical metal. February saw a lower percentage after prices peaked and aggressive cash settlement followed. However, registered inventory is now lower, and the physical market remains tight. Meanwhile, developments in China have added another dimension. On March 4th, James Henry Anderson reported that combined Shanghai Futures Exchange and Shanghai Gold Exchange silver vault stocks had declined to 752 tons, or 24,200,000 ounces, described as the lowest level in a decade. He stated that either silver must trade higher to attract new inventory, or Chinese authorities may need to halt silver withdrawals. In early March, Shanghai silver traded at a 17% premium to Western spot prices. In January 2026, China implemented a silver export licensing regime, requiring exporters to hold at least 80 tons of annual production capacity, excluding many smaller producers and traders. On January 26th, the Shanghai Futures Exchange reduced daily silver position opening limits from 3,000 to 800 lots per session, a 73% reduction. Beginning January 28th, multiple Chinese silver and gold funds suspended new subscriptions. China accounts for roughly 17% of global silver mine production and exports between 4,000 and 5,000 tons annually. Restrictions on exports reduce supply available to global markets. Exchange-traded fund activity has also played a significant role in recent weeks. Since February 9th, retail investors sold approximately 15 million ounces of physical silver through ETF redemptions. Holdings in SLV declined from around 842 million ounces in early February to approximately 827 million ounces at the trough. Across the broader silver ETF complex, holdings fell from about 870 million ounces at the December 2025 peak to roughly 828 million ounces, a reduction of 42 million ounces. Despite this selling, key indicators of physical tightness did not normalize. Lease rates remained elevated. The one-year silver swap rate on March 3rd stood at negative 2.973%, with the risk-free rate near 4.25% and storage costs around 0.27% annually. The deviation from fair value was calculated at approximately 7.2%. The negative swap rate reflects forward pricing below levels implied by cost of carry. The one-month silver lease rate was approximately 3%. The 5-year average lease rate from 2019 through 2024 was negative 0.09%. The forward curve remained in backwardation, with May futures at $83.47 and July futures at $84.08. The July minus May spread was negative 60 cents, and the carry-adjusted basis showed the market trading below fair value based on cost of carry. Retail flows have begun to reverse. As of March 3rd, SLV reported 30-day net inflows of $1,750 million. SLV was trading at a negative 4.86% discount to net asset value. Cumulative global silver deficits since 2021 total approximately 820 million ounces, including a projected 67 million ounce deficit in 2026. Photovoltaic applications consumed approximately 230 million ounces of silver in 2025, with each solar panel using about 20 grams. Global mine production is approximately 820 million ounces per year. As of March 4th, silver was trading at $85, following the earlier decline to $78.60. The May contract carries 401,400,000 ounces of open interest against 87,985,490 ounces of registered COMEX silver. First notice day is April 30th, 2026, 57 days from March 4th. Registered inventory has fallen by 14,271,000 ounces since February 9th and is 33% below October 2025 levels, when combined registered and eligible inventories totaled 532 million ounces. March delivery volumes have exceeded 52 million ounces. In China, vault stocks stand at 24,200,000 ounces, described as a decade low. Export licensing requirements, position limit reductions, and fund subscription suspensions remain in place. Shanghai prices have traded at a 17% premium to Western spot levels. ETF holdings across the complex have declined by 42 million ounces from their December 2025 peak, even as lease rates remain near 3% and the one-year swap rate remains negative at 2.973%. The forward curve continues to reflect backwardation. Gold was reported at $5,350, with a gold-to-silver ratio of 63:1. The January 29th all-time high for silver was $121.67, when the ratio was approximately 45:1. With April 30th approaching, the resolution of May open interest will determine how much silver stands for delivery. Current data show elevated delivery activity, reduced registered inventory, continued backwardation, negative swap rates, and lower vault stocks in China. This concludes our full report on the latest developments in the silver market.